Join us now, Andrew Slimmon, Morgan Stanley Investment Management Senior Portfolio Manager. You manage portfolios. You don't have to tell people what your year-end target is on the S&P, do you? You don't have to do that.
Crazy.
Do you have to do? You don't have to do that, do you?
No.
What do you have a feeling that we're at the highs and headed down from here, or?
The market's pivoting, Joe, between the micro, which is good, earnings revision. It's one of the best years I remember for earnings revisions, which is really powerful. And the macro, which is, you fill in the Iran war, AI disruption, private credit, and the worries of how that's going to affect earnings. And you had a 9% decline, and I said, hey, we should be focused on earnings revision. Now you've had a 12% rally, and the market's more focused on the macro.
So then what matters?
So what matters is
we always, and I used to make fun of it because we supposedly were going to do that on one of our primetime shows.
Yeah.
We were going to get rid of the signal, or what were we doing? We were getting rid of the noise and keeping the signal, or we were doing something. So what's noise and what's signal? I would think that if you assign a multiple to earnings per share, that you can come to a number and ignore a lot of the
So here's a simple
things
metric,
that don't
Joe.
matter.
At the end of this year, we're going to be focused on next year.
Is that like the end of the day?
You asked me price targets.
At the end of this year,
at the end of this year, right now, the number for next year, which is all that matters, forward earnings, is 375. That's consensus. That's up from 357.
Okay.
That's a big move, right?
And if rates don't come down, then what multiple do you get?
I think 20 multiples reasonable.
20 times.
Yeah, so that's pretty reasonable. Now, at 6,300, where the market was a couple weeks ago, that's a lot. Now at 7,100, market seems overbought. So I think we're just pivoting between the micro and the macro. But at the end of the day, the micro is pretty good. And so if you get a washout because of the macro, geopolitics tends to create good buying opportunities.
20 is not expensive. So 20 times 375, that's what you're saying?
375, yeah.
So that's 75.
But that's
current
7,500.
numbers. Right.
That's current numbers, and that's already up $18 from the beginning of the year.
And 20 is not expensive for market.
So it seems pretty, but look, we've had a big rally. The market seems overbought, and now you're seeing these companies come out the last couple of days, and they're reporting good numbers, but they're saying, well, we don't know about the macro, and the market's getting nervous.
When you saw the war or excursion, whatever you want to call it, in the sell-off, which was similar to Liberation Day, when you saw 13 straight up days in the NASDAQ, were you expecting that?
I think muscle memory is really important. And last year, a lot of people pivoted and turned negative, and they sold stocks. And I think what happened this year is we're not going to make that mistake again. And we got a lot of calls from people saying, hey, when's the time to buy? I don't want to make the mistake I made last year. So it doesn't surprise me we didn't have the magnitude of the sell-off. And people wanted to buy the dip. They wanted to buy the dip because last year was a great opportunity. They missed it. So I don't think we're going to get a big decline again because it would have been a repeat of last year. Too many people have egg on their faces by pivoting last year to see a real pivot.
You actually mentioned AI as one of the headwinds as far as AI disruption. A lot of people think the only reason we're moving higher is because of the benefits down the road for AI. Or just to build out the capital spending.
I don't agree with that, Joe, because no one's raising numbers because of savings because of AI. They're raising numbers.
They're raising numbers on capex from the big companies.
That's true, but the big companies haven't seen the return yet, right? So their numbers aren't going up, and that's what drives the S&P. That's to come. But if you look at all technological innovation, the market focuses on the losers first. And then it focuses on, oh, wait, this is margin profitability. I was around the mid-'90s. We all focused on, bad for the newspapers, bad for the publishers, bad for the books, right? And then ultimately, later into the 90s, oh, wait, a lot of companies are going to be a lot more profitable. And that's why the S&P doubled in the late 90s before the dot-com bubble.
At this point, don't you think that the companies benefiting from all the spending are counteracting the disruptive effects of AI? Or do you think the companies doing the spending need to show a return or they're going to get penalized?
You know what's interesting is I think this is a classic battle between Wall Street's focus on the short-termism and companies are willing to invest for the long term, which is Wall Street saying, these big guys, they're spending a lot of money, their free cash is going down. And you have the smartest guys in Silicon Valley saying, this is going to enhance return. We are going to generate. And you saw CEO of Amazon say, this is going to be very bullish for long-term growth. And so I think that's, for the industry, I think that's the battle that's going on. It's not apparent to Wall Street yet, but these companies are making the investments. So I think there's a big fat pitch here of investing in these companies now when the capex numbers haven't produced the results yet.
Would anything change in your view if oil was $150?
Of course.
It would.
100%, yeah. But
100% if it was 150.
I think 200 even. I think it would change my view. I think right now you're getting more tax receipts, refunds coming in. That's offsetting the higher prices. But higher oil is the one thing that we've imported from abroad.
Another thing that President Trump said yesterday, I would have expected oil to be 200, and I would have expected the Dow to be down, or the markets to be down 20%. I mean, it's still early. That's what scares me.
Because
you sure?
Because last year, the market learned last year. Don't pivot on what he says.
If we got bogged,
downturn in tariffs.
Because tariff market's saying I'm not going to get burned by these, headlines.
Well, do you think it's because they think eventually the president will be swayed to not allow those things to happen to the market?
One man can pivot. He pivoted last year and caused tariffs to come down. Yeah. One man can pivot and cause oil prices
one man can't pivot and open the strait.
Maybe the slight distinction.
Right. It's not one
may
person.
not just be a one-man choice.
You can't open the strait.
This is not the one-man choice.
It's not going back to 65, but it's probably not going to 150 if he pivots.
Right, but then the question is, what is it? And are we sitting at 90 on WTI or 99
the typical pattern is you retrace about half, so 80. Is that going to cause the economy to collapse? I don't think so.
Well, you tell me what you think is going to happen in the Strait. Because the one man who flips and says, OK, I'm out, doesn't mean that they're out.
Right.
Iran's not out.
We got more oil coming elsewhere. Look, at the end of the day, Andrew, you always have to be very careful on getting too bearish on oil when it goes off, because somehow more oil finds its way to the markets. Okay. You want to be bearish on oil when it gets close to triple digits.
By bearish, you mean prices going higher.
Prices going down. I'm saying don't buy into it's heading for the $200.
Right.
It's not been the right trade for the market.
Right.
There's a lot of supply out there.